Good day to you all, ladies and gents. Welcome back to Matrix Investing, your number one capital market investing mentor. Now today we shall be looking at what long-term investing in shares actually means, the perspective behind it, and the advantages that an investor gets when it comes to having this sort of investing strategy. Now, if this is the very first video you're watching, we highly advise you to watch the previous videos so that you can have a better understanding and a clearer picture of what exactly we're talking about. But also, if you by any means find this video useful, if you enjoy consuming this content, please give us a thumbs up, hit that like button. If you haven't subscribed, please subscribe please. And also click that notification bell so that YouTube can notify you each time we upload content. Now, with that said, everybody, let's get down to business. So what is long-term investing in shares? Starting off by defining what long-term investing is. So long-term investing is an investing strategy of which an investor tends to invest in a project and hold that particular investment for over a long period of time, which is usually more than 5 years. So what we consider as long-term investing is basically when an investor holds onto an investing scheme for more than 5 years. So then if we're talking about a scheme that is held by an investor for 5 years plus, then that is long-term. That ticks off as long-term. So then as far as investing in shares is concerned, basically if you hold on to shares for more than 5 years in a particular business, then we might as well conclude you as a long-term investor. So then, as far as investing in shares is concerned, investors with a long-term outlook of owning shares in a company usually have a perspective that they're buying an entire business, even though that isn't actually happening. So then, such a perspective helps them pick well-performing businesses, as well as being careful in the decisions they make upon choosing investments. So then, technically, long-term investors, most successful long-term investors usually head on before investing in shares. They have this sort of perspective that, okay, listen up, we're going to buy an entire business, have freaking 1% ownership of that business. So then whatever we do, we have to be really, really careful in what we're picking. We do not want to pick a business. We do not want to own a business that is going to hurt our capital in the long run. So then basically for these sort of investors, long-term investors aren't investing in shares for the sake of investing in shares. Long-term investors usually tend to look at the value of a business. So then when they have that perspective that they're going to own all of this business, that they're going to own the entire stake, like the toll of owning an entire stake is very high on such investors. So then therefore they have to be very, very careful on the decisions they make. They have to analyze more carefully. They have to make sound decisions. They have to make the right choices. So then by having such a long-term outlook, they'll be like, listen, we do not want to have 100% ownership in a business and later on have our own capital deplete instead of appreciate. So then because of this, such investors tend to have this sort of perspective that they're going to buy an entire business, and by doing this so manages to increase their accuracy as far as digging through annual reports is concerned, as far as studying the investment is concerned, and ultimately choosing the best shares to invest upon. So then let's check out the advantages of long-term investing in shares. So then before I dive into the advantages of long-term investing in shares, I just want to clearly clarify long-term investors from short-term investors. Now, as far as short-term investing is concerned, we're basically looking at the sort of investors who get into investing in the capital market for short periods of time, i.e. less than 5 years, and usually such investors are more focused on the share prices of that particular business and not the actual value or that the business has to offer. So then more priority, all eyes on the share prices. That's for short-term investors. So then we'll be looking at these advantages, and we'll be trying to look at the comparison. We'll try to look at these advantages for long-term investors in comparison to what it actually is for short-term investors. So then starting with the first advantage, it reduces the chances of getting a loss or missing out on an opportunity. An investor with a plan of buying shares and holding them for longer periods of time is more likely to becoming very cautious with the investing decisions he or she makes. Even before investing, he or she should have done some intensive research, figure out well-performing businesses from the bad ones, and out of those that do well, the investor would look at a business less riskier and can provide greatest return on capital invested. Therefore, an investor who bought shares of well-performing businesses with safety in capital invested as well as rising dividend payments. So then, such an investor, like I told you before, such investors come in with the outlook that they're gonna they're gonna have 100% ownership into a business. But we'll say that isn't likely so, because in that business is already existing shareholders with a significant stakeholding or significant ownership into that business. So then, when we say it reduces the chances of getting a loss, so then what do we mean by a loss? What we technically mean here is that long-term investors tend to become very careful and much more accurate and more decisive in choosing and filtering out investments that perform well from the ones that perform badly. So then by doing so, this automatically reduces the chances of losing. This reduces the chances of losing, and this is because automatically most of where they mostly prioritize investing over is the best of the best businesses, the top notch, the cream out of all the other impurities. So then by doing so, by having to invest in such businesses, they get to reduce chances of getting losses. They ain't after share price fluctuation, of which this could be found both in good businesses and bad businesses. You could profit off of share price fluctuations from bad businesses just as the same way you could do from good businesses. So then that's number one. It helps them reduce chances of getting a loss. Number two, missing out on an opportunity. So then technically by holding on to an investment in the long run, good businesses eventually tend to have an increasing share price over time as well as rising dividend payments. So then technically a long-term investor will not miss out on any sort of opportunity, like as far as losing profits is concerned, because once an investor jumps in or buys into an existing well-performing business and holds it for very long periods of time, whatever sort of profits, capital appreciation, and whatever sort of dividends, that is dividend payments, this investor shall not lose. This investor shall get each and every single advantage that there is to get from long-term investing, that is capital appreciation and dividend payments. So then, now, if we compare this to short-term investors, so then, okay, short-term investors might as well have their own research. They might as well have done their homework. They've done their research. But then you have to consider that most of these short-term shareholders, they're basically other, aka called day traders. Most of these people tend to look at the prices. So then what they mostly prioritize over is a brief of what the business is. They want to know what the business is about, its situation, but then mostly looking at the share price, looking at the graphs, looking at the historical share prices and all of that. So then by doing so, an investor, there are greater risks involved, because what if this sort of investor, because fluctuations, like I told you, fluctuations in daily prices could also happen in bad performing businesses. So what if investors such as these are more attracted to companies that perform badly but have good price fluctuations, like they can see a chance of getting some capital appreciation. So then by investing into these sort of bad businesses, they are increasing their chances of getting a loss. What if this company tends to produce its financial statements indicating that it has done poorly? Existing shareholders from the inside realize that this business isn't good, and most of them want to sell out their shares, and there's less amount of buyers who want to buy into the particular share. So then basically, if this sort of day trader or this sort of short-term minded investor is by any chance involved in a bad business, and in such a case scenario, if such scenario were to happen, share prices would go down. So this automatically means that this sort of investor would have a depletion. There would be a decrease in the capital he or she has originally invested. So then missing out on an opportunity. Basically, short-term investors tend to miss out on opportunities in the case that, let's say, they do invest into shares, their prices do jump a few points high. They would feel kind of satisfied. They'd be like, okay, there's no way this business is gonna go higher than this. Maybe, you know what, for the sake of risk, I'm just going to sell my shares here in case they plunge. So then by doing so, they're missing out on the potential opportunity of the prices to go. Like, what if it's a great business and the prices could rise up even more? So then by any chance that this investor pulled out of that investment and the share prices were to continue growing, like they would go bullish, so then this investor would have missed out on opportunity. And in case this investor were to say he or she would want to buy shares again into that existing company, he or she would buy less shares because he or she is buying them at a higher price. But if he had originally bought them at a lower price and hold on to them throughout, then he or she would have more shares and would have greatly benefited from the capital appreciation. So then advantage number 2 is it reduces disturbance and worry. So then an investor with a long-term perspective buys shares as if buying an entire business. But after performing enough research on a particular business and comparing the findings with other business from the same sector, such an investor doesn't necessarily need to regularly follow up on how the business is doing, except when it started to undergo bad financial performance, unlike before. So then, therefore, to a large extent, an investor doesn't have to worry or follow up on the business from time to time if he or she is sure that he or she has invested in an excellent performing business. So then long-term investors, basically as far as long-term investing is concerned, the huge effort they have to put in when it comes to investing is the part where they have to do research, filter out good businesses and bad businesses, ensure themselves and have confidence that they're investing in a good business. And once that's done, they basically after that, there is no hustle. Like, it's all easy peasy. So then you just have to check in the company once in a while. So then, like I was telling you, such investors don't have to check in with the business from time to time. Why? Because they've already done their heavy foundation worth of research and have realized that this company is the best of the best. So then once they invest into it, they're pretty much sure and they feel more guaranteed that this business over time, in the long period of time, if everything remains constant, that is, if the business keeps on performing well, then these investors will have an appreciation in capital invested and awesome sticky dividend payments. So then basically these guys don't have to check in with the business from time to time. The most they'll do is maybe check out the annual reports of the company. So then that's like once an entire year. Maybe they'll have to check out the quarterly reports. So then that's like after every 3 months. So then, yeah, such investors don't have to worry or like don't have to disturb themselves. Like, they don't have to go through this sort of hustle. As far as worry is concerned, let's say the prices of a particular company were to go down a little, they wouldn't have to panic like, oh my god, what if I'm losing my capital? What if the value of my capital is depleting? They don't have to worry about share price fluctuations because they know that they've invested in a good company, and over time, share prices tend to reflect the quality and awesome performance of a business. So then, therefore, these guys don't have to worry. Simple price fluctuations don't scare them off. They're just like, man, we know this gig is gonna explode couple years in the future. So then, that's technically it. Checking out the third advantage, which is continuous growth of an investment. So, after performing research and investing into a business that performs really well, all that remains is to continue to invest in that particular business. That is, if the investor feels like he or she needs to invest more capital into that business, and let time take its course, because the value of capital that an investor has invested in that particular business will grow in accordance to time, because if the investor did good research and the business chosen for investing really is an excellent performing one, then as time goes on, if the business will do well financially and keeps on growing, then the share prices of that business are more likely to rise more and more. So as in, more investors would want to cash in the business, and therefore the investor who invested in that particular business will get a great appreciation of capital in the long run. So then, like basically, what this actually means is that if an investor if an investor has already invested in an excellent performing business and the business continues to do well throughout time, then the share prices will, in accordance to time, will rise. Like the share prices are more likely to reflect the quality and the excellence of that business. So then why is that so? This is technically because if you've invested in this particular business at a low share price, or if you've invested in this particular business at a certain share price, and you hold on to it, and the business is performing well, and the business continues performing well, and the business continues paying out good dividends, and the business continues growing in capital, so then technically more investors would be like, this is a really good business, maybe we should actually cash into the business. So then more investors would want to invest in the existing business. There would be more investors who want to cash in that existing business. So then, due to that, like there would be more demand, for the shares. Now due to that, that causes the share prices to rise, because the investors who are on the inside, on the other hand, would be like, look at this demand. So then if they raise prices, like if they want to sell their shares at high prices, the investors who want to cash in are more likely to accept the premium price they would have to pay for owning such shares. So then it is because of that rise in price that causes the share prices to rise. The share prices rise due to that, and you, the investor who's just holding on to his shares, you get to feel your capital grow as time continues to go on. So then, however, though, huge disclaimer, growth doesn't go on forever. They'll reach a certain time and stop growing. So then, don't get too optimistic right there, being like, oh my God, so then if I find an excellent performing business, and invest in it, it will continue to grow forever. No, that won't most likely happen. But then, good gig though. I mean, you'll grow for a good number of years, and maybe when you feel like depending on your motive, if your motive is to cash out with capital appreciation, then you could do so, but in the long run. But then if you want to keep on holding into that business and continue enjoying dividend payments like Matrix, then you could continue sticking on with the business, and as long as it's performing well, no harm on you. So then example, if an investor had invested in the TCC, that is the Tanzanian Cigarette Company, at the time it was listed in the Dar es Salaam Stock Exchange at a market price of 410 shillings in the year 2000, then the value of such shares as far as 2020 is concerned would have been worth 17,000 shillings. So then let's look at the intensity of how much wealth or how much appreciation this is. So then I'll just pull out my calculator here, and let's check it out. So then imagine you bought your shares at 410 shillings. Let's say let's assume you invested a million shillings in the year 2000 at a market price of 410. So then automatically you would have 2,439 shares. So then 2,439 shares. Now let's assume, in this assumption, we'll assume that you haven't reinvested your dividends, because this company does pay dividends. We'll assume that you have not reinvested your dividends. That's one. Two, we'll assume that you have not put in any additional capital whatsoever. So then the 1 million you invested back in 2000 is the same. It has the same number of shares. You have 2,439 shares up to 2020. So then, as far as 2020 is concerned, the share prices are at 17,000. So then, the current value of your capital would be 41,463,414. So then, just look at that jump from a million to 41 million. You've been able to walk out with 40,463,414 on the original capital invested. So then just look at that. That's just 40 million on 1 million. That's 40 million more on the 1 million you originally invested 20 years ago. You see how time is very relevant as far as investing in excellent businesses is concerned. So then this is why Matrix believes that long-term investing is the actual gig and is like the ultimate creation of wealth. So then you can see by the intensity here that this person has been able to make, this person has been able to make tons more cash, 41 million over the original investment, which is a million. This person has been able to make like 4,100% returns on the capital he or she has invested. So then that is a result of long-term investing, and that is why we say patience is key. So then let's check out the next point, which is an investor would continue to enjoy payments upon his or her investment. So then as far as an investor keeps on holding on to his or her shares and invests additional capital into that business, his or her dividend payments increase with the increase in capital invested. So we've talked about this before, but then he or she is more likely to get paid consistently on an annual basis if the business has a track record of paying dividends annually. So then basically one of the characteristics, one of the features that good businesses have is consistent dividend payments. So then like if a business pays out dividend payments throughout like its financial years, then that just indicates that this business is well off to pay dividends throughout good times, bad times, all times. Because like we all know that in all those years, there is no way you can tell me that all those years for that business was sunshine and rainbows. Like there must have been some dark years. So then basically, if an investor's if the business been able to pay out through all those times, then we suggest then basically that business is well off paying dividends for any sort of time. So then it's more likely to get paid consistently on an annual basis if the business had a track record of paying dividends annually. And also, if the business is excellent performing, now this is a juicy part, if the business is an excellent performing one over the long run, dividend payments are more likely to increase, reflecting the excellent performance of the business has been providing throughout the years, and hence greatly increasing shareholders' payments. So then technically this is it. If you invested in a business at a particular point in time, let's say the business you had good track record, you went through all its previous data and you invested into this business, okay? So then if you invested into this business and as time went on, this business kept on performing well, so then as far as dividends is concerned, dividend payments would keep on rising. So then like if you got paid, let's say 5 shillings per share this year, next year the business does way better than this year, it pays you 10, the year after that maybe pays you 12, the year after that pays you 15. So then like there's an increase in dividend payments per share. And this is not on you. This ain't one of those like this is different from the scenario where you're like, if you invest more capital you get more money. Now this one is basically the company offering more cash as dividends. So then let's check out the example. Maybe from here we'll make more clarification. So then back in 2006, when Twiggy Cement was first listed in the Dar es Salaam Stock Exchange, it paid an annual dividend of 28 shillings per share. So then flash forward to 2020, the same company had paid a dividend price of up to 290 shillings per share. So then the only way we can check out its impact is by pulling out the calculator. So then let's check it out. So then say you invested $1 million in Twiggy Cement back in 2006 and at the market price of 435. I think, wait, this is the price it was listed for in the stock exchange back then. This is the IPO, the initial public offering, the price of which the shares are first sold at in the market. So then let's say you got 2,298 shares. So then as far as year one is concerned, you got paid a dividend payment of 28 shillings per share. So then that's like 64,344. Now here we're just gonna assume that you did not get your tax cut, like you didn't get to pay out tax for your dividends. Let's just say you got this entire thing, like 64,344. So then if we check it out, like if you try comparing it with the original 1 million investment, then you get 0.064. So then if we change that to percentage, that's a 6.4%. So then basically off of your dividend payments, as far as 2006 is concerned, you've been able to gain 6.4% of your original capital invested. So then let's just say you had your original 1 million, you didn't reinvest any sort of dividends, as well as adding on to any sort of additional capital. So then, if that's the case, your 2,298 shares, as far as 2020 is concerned, would have paid you a dividend payment of 666,420. So then, again, assuming no tax cuts, you got the whole thing. This is just an assumption right there. So then if we're to compare this with the 1 million you originally invested some years back, so then technically change that into percentage, then you'd have been able to gain a 66.6% return on investment just as of 2020 alone. Now, remember, this business had been paying, I've checked its records, its historical financial records. It's been paying dividends throughout. So from 2006 up till 2020, it's never missed out in a year it hasn't paid its dividends. So it's always been paying dividends. So then, technically, just off of 2020 alone, you've been able to gain 66.6% worth of return on investment. Last year, as far as 2019 is concerned, the previous year, it paid 290 shillings per share. It remained consistent at 290 in the year 2019. So then, if let's say we were to add the same, so then you would have gotten the same sort of return, as of last year. So then, just imagine, out of these 2 years alone, you've been able to get your original investment and a 33% bonus return just as of these 2 years alone. Now now remember, as far as our example is concerned, you've owned this business for a bizarre period of 14 years. You've had your stakeholding into to this cement for 14 years. So then just imagine, if you're to accumulate all those returns, how much do you think it would be? It would probably be way more than 133, and way more than 200. So then this is technically what we're talking about when we say long-term investing is the gig. So then the final point, as far as our discussion is concerned, is history is on your side. So then, in the world, we've seen stories of how lots of people became wealthy by increasing their capital, by investing in the stock market, buying shares into well-performing companies and holding them for the long run. From the time they were small in size, the businesses kept on growing and performing well. Investors who discovered the potential of these businesses when they were small and had the opportunity to invest their capital in them have had their capital grow in great extents, but also attaining dividend payments that kept on increasing as time kept on passing, until eventually providing greatest levels of wealth for such investors. So then technically what this basically means is that, hey, this long-term investing strategy or matrix like we're talking about right here isn't some strategy we just woke up from our sleep and was like, oh my god, this is the best strategy in the world, because we just thought of it and we thought it was awesome theoretically. So then there's people who have practiced the principles of long-term investing. They've practiced the flow, the art, and look at them. Some of them pulled it off to being one of the richest people in the world, in the planet. So an example of such investors are Warren Buffett, there's Jeff Bezos, there's Bill Gates. So then looking at Warren Buffett, look at the countless number of shares, countless number of companies, they're not countless actually, the few best number of companies he's invested in the American Stock Exchange. The best of the best companies he's invested in, he's held them for more than 30 plus years, and look at the payments, or look at the dividends he's been getting. So then an example is Coca-Cola. I read through Buffett's investment with Coca-Cola. He's bought it So then he bought it at $1 billion. It's been able to give him a capital appreciation. Like the valuation right now are more than 19 billion. Like the value for Coca-Cola, like the value of the capital he's invested into Coca-Cola is more than 19 billion. From dividend payments alone, this guy's been able to rip off like this guy's been able to benefit $7 billion off of dividend payments alone. So then look at this guy. This guy just basically enjoyed both sides of the coin. Buffett was able to enjoy dividend payments, was able to enjoy a huge, nice, stakey capital appreciation. So then, but remember, this guy he's held through this particular company for more than 30 years. He's had Coca-Cola since the 1988. So then just look at it. It's been more than 30 years. Yeah. So it's been 32, I think. Yeah, 32 years. Just imagine, and look at how much profit he's been able to gain from that one particular company. And this is us talking about Coca-Cola alone. I mean, look at Berkshire Hathaway's currently trading at around more than $200,000. If you're to check its daily graph, like if you were to check the share price history graph, this thing was selling at around $7,000. The time it was selling at around $7,100 back in the 90s. So then, just in a span of 30 years, look at how much his own company, Berkshire Hathaway, look at how much it's been able to attain as far as capital appreciation is concerned. So then, looking at Jeff Bezos, he founded Amazon. When it went public at a price of $18 back in 1999. Flash forward 2020, this company is worth more than $2,400. Like last time I checked the share price, it was like trading at around $2,400. So then just look at the extensive, look, just this person, like imagine how many shares Bezos has in his particular Amazon company. And look, taking out $2,400, you minus 18, so then that's technically 2,380. Is it 82? $2,382. So then that's how much he has attained as profit alone from one share. Now look at all the other shares, like how many shares does he have? So then that's how he's created his wealth. And we're just looking at we're basically looking at capital appreciation. We're just looking at one side of the coin. So yeah, going to Bill Gates, he founded Microsoft. Time he bought these shares, time he had his company listed in the stock price, till what Microsoft currently trading worth for right now, there's a huge capital appreciation there. But what I liked about Gates was that he was able, like, he grew his company. He had all that amount of shares. So then when the shares, like when they appreciated in value, so then he sold some of his Microsoft shares and used the capital appreciation, used that current capital valuation, used that capital to invest in other different companies that show potential of excellent performance in the long run. So then we technically see how most of these wealthy Mongols, most of these guys, how most of them became what they are today due to one way or another engaging themselves in long-term investing into shares. So then some of them might have benefited from capital appreciation alone. Some of them might have benefited from both capital appreciation and dividend payments. The returns are enormous. The returns are enormous. They're great. So then, with that said, folks, thank you also so much for consuming our content. If this video has been helpful, if this video has helped you out, please give us a like. Please hit that like button. If you haven't subscribed, please do so. Please subscribe. Smash the subscribe button. Hit that notification bell so that YouTube can notify you each time we upload content into YouTube. But if you're also on other social media platforms such as Instagram, Facebook, Twitter, you can also check us out there. Our account is Matrix Investing. You can check us out on Instagram, Facebook, and Twitter at Matrix Investing. So then we basically try our very hardest to upload content on a day-to-day basis that is regarding investing in the capital markets. So then never know, check us out there. You might get some interest about investing in the Tanzanian stock exchange, you could do so. You could help us out. You could DM us. We're only a DM away. You could ask us a question to the DM. We will be happy to answer. So then, thank you all very, very much, and have